I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Eric Hadik, president of InsideTrack.com, Inside spelled I-N-S-I-I-D-E. Welcome back to the show, Eric.
Oh, thanks for having me back, Jim.
The price of oil up the last 3 days, now over $51 a barrel, and that's had a very positive effect on the Canadian dollar. What other currency action are we seeing out there?
Well, starting with the Canadian, I think that it's definitely in a critical phase here, because even though oil is rallying to new highs in the year and new highs for this rebound, the Canadian is more in a reactive rebound after an initial decline, and it would be very interesting to me and kind of reinforce my 3 to 6 month outlook for the Canadian dollar if it were to set a lower peak in the coming days or weeks, even as oil sets a bit of a higher peak and then turns down. There's a lot of factors in the Canadian that are at a very pivotal time, a monthly trend pattern that I watch, a pretty consistent 11 to 12 month cycle that is projecting a top in here. And also my outlook for the U.S. dollar to start seeing some new strength that might weigh a little bit on the Canadian, even though it's not always a complete one-to-one opposite correlation.
What is the usual relationship between the U.S. dollar and Canadian dollar?
I don't know if I could even pinpoint that down, and I often warn my readers about holding too fast to any sort of intermarket correlation, because so much of it has to do with what the traders are focused on. And, right now, like you're pointing out, the price of oil is really the focus. Well, if oil goes into a trading range, all of a sudden now, something like the Canadian dollar, they start to focus on other fundamentals and or other technicals, because oil might just get into more of a trading range. And you see that with so many correlations, whether it be dollar to gold, that, people think, well, if the dollar's rallying, gold has to be going down, or if gold's rallying, the dollar has to be going down. But it's not always as simple as that. And so I tend to shy away from a complete correlation, although in theory it should be 180-degree opposition, that as the value of the U.S. dollar goes up, the corresponding value or relationship to the Canadian would go down, and vice versa. But again, it depends on what's impacting the dollar, what's on the forefront of traders' minds. But so that's why I really look at each one individually, and then see where those correlations come into play, or where we might be in a phase where one of the markets is in consolidation and the others extending a particular trend. And with that said, what I am looking for in the second half of 2016 is for the U.S. dollar to see a final rally, and that could be while some of these other markets, the Canadian dollar and even what I was just referring to with gold, most likely those markets would be in more of a volatile, consolidated phase, so that, yes, they react sometimes to the big moves in the U.S. dollar, but when it's just trading range action, they're each kind of playing on their own fundamentals and own factors.
What kind of phase do you see oil in right now?
I think, well, you'd have to go back to kind of my longer-term analysis that we were talking about all through 2015 and early this year, that I had major cycles pointing down from mid-2014 into January of 2016, at which point I thought we would see a multi-quarter and potentially a multi-year bottom take hold in oil. And so right now I think we're in a prolonged bottoming phase, currently in one of the advances within that bottoming phase, but I think that we're going to see some backing and filling along the way too. Crude really has probably its most significant resistance level up around the $60 range, and that's based both on the charts and technicals as well as fundamentals and the approximate production cost and profit level for things like the U.S. fracking industry and some of your other oil production. So that is definitely probably the most decisive level, even when crude plummeted into early 2015 and tried to get a rebound going. That rebound stopped abruptly right around the $60 level, and I think that you could see that same level curtail any immediate advances that we have right now, but I would be looking for it to ultimately be broken either later in 2016 or early 2017 when oil is ready for a more sustained advance.
We'll have more with Eric Hadik right after the break.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Eric Hadik. Eric, earlier you mentioned that the markets and other commodities don't always match up. So often we say if the equity markets are up, gold will be down. But today I noticed that gold is up and the equity markets are also up, although the Canadian Venture Exchange, which is closely tied to gold, is down. So they don't always completely match up. What kind of cycles do you see with gold and the gold miners?
Yeah, I kind of stress that the day-to-day correlations are very dangerous to try and trade off of, because there can be different factors influencing those markets. Even last week when we see weak jobs news in the U.S. and bonds and notes surge, interest rates drop. Initially, the stock market drops, but then stock indices kind of like that no higher interest rate threat type of fundamental factor, and that also helped gold and silver too to rebound. From an intermediate cycle basis, I still contend that gold and silver have completed their upside for the first 3 to 6 months of 2016. They very precisely hit the price objectives that I was discussing with you back in early 2016, that gold should get up to that 1305 to 1315 range, and that I expected that range to be tested as part of the initial advance, but not to be broken until later in 2016. And with all of that kind of coming to fruition in early May and then seeing an initial sell-off, I think that gold and silver are what is best described in Elliott wave terminology as a second or two wave, where you see some volatile two-sided action. You see an initial sell-off, then you see a pretty convincing rebound, and then at least one more sell-off that usually takes you below the lows of that first sell-off. So we're kind of in the middle of that phase by my interpretation and from my perspective, and that I had gotten a 2 to 4 week sell signal in gold in early May, was projecting it to last until late May and to get gold down to 1190 to 1200 and silver down to 1590. Both of those downside objectives were met in late May. We took off some of the hedges we had for a downside move, and then I was looking for a brief rebound, which we're seeing unfold now. I think that gold and silver are approaching the upside targets for this rebound. There's two sets of them that I published last week, and both markets are getting close to the first set. And just depending on how that level is tested will help me to determine whether I think the second levels are even possible to be seen, or whether gold and silver turn back down at that point and enter what would be a C wave of an ABC correction in the overall market. But I don't expect gold and silver to enter another sustained advance until a bit later in this year.
In other words, perhaps hold off on purchases right now and take a look at possibly lower prices. How much lower?
Well, as far as the timing of purchases, that really has to be determined by what your overall investment strategy is. And if it's something of averaging in, then each of these pullbacks gives an opportunity to do that. As far as downside, I still see that 1190 level in gold as being a very decisive one. There's a decent chance, depending on where we peak in the coming days, that gold could spike below that and possibly even get down to the 1150, 1160 range. But that's something that, because it's more short to intermediate term analysis, it hinges on what happens in the coming days here. So that's really what I'm going to be watching and looking for an appropriate signal that clarifies that for me.
With U.S. equity markets, there's a couple of different theories. Some people think that the massive correction in January and February was enough to keep the market healthy and that the advances are real. Others are saying it's a shadow advance where there's no substance to it, and it's being set up for a major drop perhaps in August or September.
I keep going back to what I said in late 2014 and early 2015, and I know I sound like a broken record to keep reiterating it, but since it keeps happening, it's worth repeating. And that is that I thought the majority of 2015 and 2016, particularly in a lead index like the Dow Industrials, the one that's quoted and watched the closest in a lot of cases, or at least in the media, I should say, that action in 2015, 2016 would closely resemble what the Dow Industrials and even the S&P saw in 2000, 2001. And you had an initial shoe drop in 2000, that being the bursting of the dot-com bubble. In 2015, you had kind of an initial shoe drop with a lot of the Asian indices really plummeting between June and August. In 2000, you saw about 15 months of volatile two-sided action where the Dow would see a 2 to 3 month sharp decline, would spike to new lows, would get the bears really foaming at the mouth, and then it would bottom with no warning and start to build a base, and then next thing you know, it was in a 2 or 3 month rebound that would do just the opposite, would go up, almost reach the previous highs, get the bulls starting to tout their next upside objective, and all of a sudden the market would top, turn back down, and eventually spike barely to a new low, but not follow through. And you saw that type of action go on for over a year, close to a year and a half in some indices. And that is what I've been expecting for 2015, 2016, and it's what keeps unfolding. And so I expect that to continue into the third quarter of this year. And if that is the case, then we've seen a rebound here, back up near the previous highs. So we're getting to a point where a lot of the equity markets should begin to roll over to the downside and see a new decline. But I don't even think that will necessarily accelerate to the downside. I think it's going to see a nice sharp sell-off, but probably hit some support and still stay in this volatile range until a second shoe drops a little later in the year.
What about food commodities? We've had some massive flooding in Texas. Has that going to have a major influence on what happens with crops this year?
That also just plays into the food crisis cycles that I know I've discussed with you over the last year. And I start out with the big multi-decade, multi-century perspective, and just documenting how on a very consistent 40-year basis we have seen significant food crises both in the U.S. and around the world, and that there's even a fundamental link when you listen to descriptions of cycles within the sun and the approximate 40-year cycle of what they call the Great Conveyor Belt in the sun, governing its magnetic storms, sunspots, which have a significant impact on our climate. And in almost every one of these cases, the second half of the decade on that 40-year cycle basis has seen a significant food crisis. And I've had a lot of other technical and cyclical work on a more near-term basis that just kept telling me to look for major bottoms in grain prices in many commodities in late 2015, some of them stretching into the first quarter of 2016. And then we would see the onset of what I believe will ultimately be a 3 to 5 year bull market. So these precipitation and climate and weather events are powerfully corroborating that technical and cycle analysis and giving what I think is the first leg up in what will be a much bigger bull market. You talk about the flooding here, but really the driving force behind particularly soybeans the last couple months has been crop shortages in South America, and that was even triggered by extremes, drought in certain areas and flooding in others, and that to me is just kind of the starting pistol being fired for this overall food crisis cycle. I thought that we would see an initial surge in grain prices into the third quarter of this year. I even pinpointed the month when I thought that this thing would culminate, and that similar to what I was just describing in gold and silver and earlier describing in the Canadian dollar, that you get that initial rally, then you get a consolidation phase, some other things come into play, the markets build a higher plateau from where they can then accelerate higher, and 2017, 2018 is when I think that we are going to see that in a lot of key commodities. And there are many fundamentals coming into play that are starting to reinforce that analysis. And I think I may have even discussed it with you late last year, where towards the more the fall or late summer time frame, there in the last couple of years, there have been these kind of surges in locust plagues. Everywhere from southern Russia to Africa, and then in early this year in South America during their late summer period, and that, you know, something that you don't even think of, or you talk more about in ancient times or something. All of a sudden, this is creating a stress on crops, and then there's different fungus and diseases that they've been battling with on a intensifying basis, and it's different factors right now happening more on an isolated basis, but I think that they are poised to come together and create a more synergistic impact. If my cycles are accurate, that would be in 2017, 2018, even lasting into 2019. So I think we are in the early stages of what could be a very dramatic bull market.
Eric, thank you so much for chatting with us.
Thanks for having me back, Jim. I appreciate it.
My guest has been Eric Hadik, president of InsideTrack.com. You're listening to HowStreet.com Radio. Find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. Comments or questions for the show can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com Radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com Radio is a production of HowStreet Media Incorporated.